Merci, putain, je parle depuis tout à l'heure, il n'y a pas de son, ça fait 45 minutes. Merci Mathieu de m'avoir sauvé de ça. Bah du coup, j'étais parti super loin, enfin ça fait super... it's been a long time I've been talking. Second time that it happens to me. Fuck. So yeah, I was talking about... I talked for so much, but so much time. So basically, the introduction was basically I explained that I was doing an educational stream about trading and how it's functioning. So yeah, I explained what is trading. I'm gonna start again then. And basically, trading is the act of buying and selling financial assets with the aim to make a profit. To do that, like financial asset can be anything from ranging from stocks, commodities, currencies, cryptocurrencies, bonds, and bonds. And basically the goal is to generate a profit. If you buy something with the hope it's gonna go upward, you're doing something called scalping. No, you're doing something it's called taking a long position. And if you're doing taking a position, selling something in the hope it goes down so you can buy it cheaper later, it's called a short position. In order to do a short position, you need to buy. Your broker is gonna lend you the asset you want to sell. You're gonna sell, then buy it back later and give it back to your broker. So it's neutral for your broker because at the beginning he has an asset, at the end he has the same asset. And meanwhile you have profited from the decrease in price of the asset. So brokers are basically the intermediaries that allows you to buy and sell assets on financial market. You can't buy and sell like do trading or investing or anything without a broker. Their job is a licensed profession like a doctor or a lawyer, and they are here to basically provide you with they're gonna basically execute your trade for you. So they're gonna buy and sell. If you want to buy, they're gonna buy for you, and if you want to sell, they're gonna sell for you. So basically, I've already talked about it, but nobody heard me, so I'm gonna start again. So one of the first steps when the trading day starts is to understand what is the economical context of the markets, what are on the mind of the investors, and try to anticipate in which direction it's gonna go. In order to do that, we do something that's called fundamental analysis. It's basically analyzing every one of the economic, financial, and other qualitative and quantitative factors that can influence the value of an asset. One of the main things would be, for example, the monetary policy that are decided by central bank, or the result of the companies, or for example the global supply of oil, stuff like that. And we're gonna try to see if there's news, how it has evolved, and how the market is gonna, and we try to analyze it and anticipate how the market is gonna react. Then afterwards we do something called technical analysis. Once we've identified and interpreted basically the move the markets are supposed to make, we're going to do something called technical analysis. And technical analysis is the study of the price charts and patterns to identify potential trading opportunity. The main, basic concept of technical analysis is something called trend. Basically, though theorized in the 1930, something on there, so maybe 1918, that financial market can only evolve in three general trends. So upward, like here, you can see like the market is going up. So basically, we can identify an upward trend by basically having lower lows and higher highs. No, higher lows and higher high. So basically, if you look here, each new high point is higher than the previous one, and each low is lower. So the market is currently on an upward trend. If you look if we look before that, here we can see that the market doesn't have higher lows and higher high, or lower lows and lower high. So it's what we call inside what we call a range. So a sideways trend, basically. And here the market is in a lower. It's in a lower trend. We can identify that the trend it's a downward trend, because basically the higher and the lower are lower each time. The higher are lower than the previous one, and the lows are lower than the previous one. To summarize, so this is how we recognize a trade. That's like a key number one, like the basic one, like fundamental analysis 101 is to identify market trend. Then once we identify market trend, we're going to be looking for something we call support and resistance level. So a support is a level where the market is going to find like buying pressure that's going to prevent the market from falling below that price level, and resistance on the other hand is when an asset it's a price level where an asset find the selling pressure that's going to prevent the price from going higher. Once we know that, we're going to mark them on our graph, identify which level count as support, which level count like resistance. And if we look, we can see that the resistance that was like on my line here, I'm gonna make it so. On my line here, it was previously it was a resistance here, because we can see there was a selling pressure that pushed the market at a lower point, but then now we can see it has become a support, because when we reach back that level, the market went back up and some buyers entered the market. There's also indicators, but indicators tend to be like lagging, and you need to have several that that give you the same signal in order to use that, to be able to use them in a proper trading strategy. The most famous the most used one are moving average, the MACD, the relative stress index RSI, the Bollinger Band, Fibonacci, etc. It tends to be like I say, it tends to be a bit lagging, and we at Paris Academy specialize in order flow analysis. So we're gonna look at the order book and anticipate the way the market is gonna behave depending on the way the market moves, depending on the order flow. This tends to prove more efficient than technical analysis, because we can be more precise in our entry and exit points, and therefore we use the technical analysis to anticipate at which level we are going to need to be more precise in our more focused, and probably around which level we're going to enter or exit our trade. Once we know that, we basically know, or we make a decision on to buy or to sell. We basically know the big line of the process. We then we need to define for what is going to be our trading strategy. When we do trading, there's basically several type of trading. Basically, you can trade with when you try to benefit from each small move in the market, or at the opposite, when you try to take a benefit of each of the big move. So therefore you would do so. Yeah. So if you take advantage of the global trend of the market, you're gonna do something that is called swing trading. Swing trading is basically I'm trying to trade following the trend. So if I take an example here, I'm buying somewhere here, and I'm not selling until it starts to go down, so later at some point. Meanwhile, day trading is going to be, I'm going to take a position like each day and I'm going to try to take advantage of the big move. So you're going to be, for example, taking this one and you're going to take one trade, maybe two in a day, with the objective of being more benefiting from the daily move of a stock or a financial asset. Once otherwise, there's us, what we do at Paris Academy is something called scalping. Basically, we are going to take a short-term position in the market, maybe like 15-20 minutes, and our goal is going to take advantage. Is going to be to benefit from each of the small move, like from most of the small move that the financial market is having. So basically, let's just say I think it's gonna go down like maybe until here. Here I would take a short position. Or if I anticipate that the market should go up, I would then take a long position. And we're gonna we're deciding we are gonna try to we're gonna be able to make this decision based on our fundamental analysis. Scalping is tends to be quite difficult because it's scalper tend to have when you do scalping you tend to have like higher leverage than what you do if you do swing, because if you do swing trading you're gonna try to take larger move, like a longer move in time, so you won't be able to be to have the same leverage, because otherwise you're gonna get a margin call. So margin call is when your broker say that you don't have enough money on your account to cover your position, so you need to add more. And leverage is the fact to borrow money to invest in the financial market, and it's gonna it depends. So each strategy has its pros and cons. Most people tend to have been a beneficiary in each of those strategies, and it's always gonna depend on what's your mindset and what are your objectives, the time you can dedicate to trading each day, as well as your preferences. And the more you gain experience, the more you will be able to be precise and decide what you like or don't like, what you or the strategy you prefer, and the one where you're the best, you're better. So now that I've caught back quickly what I've missed because of the sound. So now we are going to talk about risk management. The most important tool of risk management is something we call stop losses. A stop loss is an order that's gonna gonna close your trade if you reach if your position is losing to a certain amount. Generally, you tend to pick them to select which stop loss level you're gonna use based on your technical analysis. And because if you choose your stop loss level only based on how much money you're willing to lose on a trade, you're gonna lose. This trade is gonna be losing. So that's not what you want to do. You want to pick a trade like a stop loss level where it's where your stop loss basically where it invalidates your scenario. So for example, let's just say I'm thinking it's gonna bounce back here and then go up. If I buy here, I'm gonna put my stop loss slightly lower here. So if the price reached there, that means my scenario was wrong, and therefore my trade was wrong, and so it should cut my position. The scenario I made was just an example. It's not. It's absolutely not an investment advice. Don't consider it as such. It was just an example. Especially, we don't know. So this is why, this is the most important part. The most important point of risk management is to put a stop loss at the pricing where your scenario and the trade you anticipated is gonna be invalidated. Then, after that, Another one is take profit level. It's basically identifying a level where you say, okay, my trade is, I've reached this level. Like I think my trade is gonna go from here to here, so I'm selling here. It's important to put it, but it shouldn't be as much. It's not as important as a stop loss. You can also decide to close your position manually, but generally it's a classic rule of trading that you need to have at least anticipated, before entering a trade, you choose an entry point, a take profit, a stop loss, and a take profit. Then, knowing that, you're gonna do some money management and decide your position sizing. And there are several ways to do position sizing, but if your point is your position should never be more than 10% of your, you should general rule of thumb is that you should never risk more than 10% of your trading account, and no matter what, never 30. And also that's basically before every time, like I said, before entering a trade, we take a short. Like we take now, we say our entry point, and we set up our stop loss level and our take profit level. Also, psychologically, trading can be quite intense. It evokes various emotions such as fear, greed, excitement, and frustration. So it's important to have to be strong with your emotion and not let you be guided by them, because otherwise you tend to make impulsive trading, and therefore, and most of the time, or even always, impulsive trading is just gonna cost you a lot of money. So that's why it's also important to before entering a trade, to write down okay, so I'm gonna take a long trade, it's gonna be from here to here, or I'm gonna take a short trade, it's gonna be from here to here. Because it then forces you to not make trading decision based on analysis and not just of impulse. Also, it's one thing that is important is to take break. It's a very common mistakes among the trader to not be able to disconnect from the market, because it's quite addictive. Once you understand that you can click and make money, or it tends to be quite addictive, and being addicted to trading will very often, it's the same way as gambling can be addictive, trading can be addictive, but trading is not gambling, because if you consider trading as gambling, you're gonna basically just lose money, and that's it. So that's not what you should do. You should always consider trading like a job and something that makes sense and have with analysis. So yeah, so like I said, also it's important to know that losses are part of trading. Everybody has losses, either like Wall Street hedge fund, even Warren Buffett, or everybody has losses. The key is to not have one loss wipe out 5 days of gain, or wipe out 3 days of gain, but basically that your loss are just well confined, allows you to be able, well confined amongst your, doesn't wipe out your gain. So if you have any question, I know there's anybody, because for half the live there was no sound. My bad for that. So yeah, it's gonna be the end of our live stream, because yeah, maybe we take a short. just for the nah. But you see, scenario I said earlier, it should have been like the market was gonna go down. That was like we could expect it, depending on how much we moved before and stuff like that. So yeah, this is gonna be the end of today's last live stream. So let's have a quick recap of what we talked about. We talked about like fundamental analysis, how it is, how it works, what is trading, like basically what are the different type of trading you can do, and why it's always important to have a very strong and sound risk management. And basically, also, what I want you to remember is that trading is something that requires experience. So please don't start trading with your real money until you have like some proven track record on a demo account, because otherwise your trading experience is gonna last as long as you don't have it's gonna last only as long as your capital, your trading capital. Yeah, as we said, trading involves like certain risks, and therefore you should always trade with money you can afford to lose. You shouldn't let your emotion drive your trading. Before the end, I want to say thank you for everyone that was here today. Sorry for the sound for the first half of the stream. Let's hope that the last half has compensated for that. See you tomorrow for the Paris Academy live stream, but in French. And thank you. Don't hesitate to leave a like and click on the subscribe button. And see you next time.